In the next 3 minutes, I want to save you a bunch of taxes in retirement. Now hold up, I know what you're thinking. My accountant takes care of that. No, he doesn't. I'm going to show you that most accountants don't take care of that, and the fact that you rely on your accountant to take care of that, unfortunately, is a mistake. Now, this money that you'll be able to save, you can use it to take more vacations. Maybe you want to buy your grandchild some useless item they don't need. Or maybe you'd like to buy something that you use once and put it in your garage. Now, no matter how you want to use that money, I'll explain to have more of it by paying less to IRS. Now, I know you think it's your accountant's job to save you money on your taxes, but there's actually 3 reasons why that probably doesn't happen. First, you probably use an accountant that's really a tax preparer. So you employ a guy who fills in the little boxes on the tax return and then sends it off to IRS. That's a tax preparer. That is not somebody who's a tax planner. Now, I know you might have this idea that you bring all your stuff into the guy on April 5th, and because he knows what numbers to put in the right boxes on the tax returns, by knowing that, he will save you taxes. That's not how it works. Knowing which boxes to put the numbers in isn't what saves you taxes. Saving taxes is a little more complex than that. In fact, the guy who puts the stuff in the little boxes is looking to the past. He's taking numbers that have already happened and then reporting them to IRS. And once it's happened, there's not much you can do. For example, let's say that last year, before December 31st, which is when the year ends, you sold something and had a big capital gain. Well, now, come April 5th, when you walk into your accountant's office, it's too late to do anything about that capital gain. You'll have to pay the tax on it. Why? Because the year ended December 31st. So you would have had to, for example, sell something as a capital loss to offset your capital gain before December 31st. Waiting until we walk in April, too late. He can't do anything for you. That's the first reason that your accountant can't save you taxes. And by the way, some of this is a little bit your fault. I think I saw you in your driveway last month talking to your neighbor. Hey Fred, my tax guy charges me too much. Where can I get my taxes done cheaper? Well, if you're looking for the cheapest guy, you're probably going to get the guy who knows how to fill in the boxes, but doesn't know tax planning. He's a tax preparer who looks to the past, not a tax planner who looks to the future. Now, the second thing, also a little bit your fault. In order to save taxes, you would have to take action before December 31st. Now, did you go to your accountant in October or November and say, hey, look, here's pretty much my situation for the year. Is there anything I can do to save taxes? Now you might think, well, why doesn't my accountant call me in October or November to do that review before the end of the year, while there's still time to do something? Well, that's because you're using somebody who's a tax preparer, not a tax planner. So somebody who's a tax planner would meet with you or review your circumstances before December 31st, because that's the only time anything can be done to fix something you've done. In fact, a tax planner is not only looking at the current year, but they're figuring out, based on your circumstances, what can I tell you to do next year, the year after, and the year after to drive your tax down to the lowest rate possible? Now, tax planning takes advantage of knowing that different income is taxed differently by IRS. There's no logic to how the IRS taxes you. It's just a bunch of rules. But if you know the rules, or you use a tax planner that knows the rules, you can exploit those rules. So instead of IRS exploiting you, you get to exploit them. That's what rich people do. Now, there's a few different types of income and they're taxed differently. For example, you get Social Security income. That might be taxed at 0%, or it could be taxed almost as much as any other income. You get income from dividends or interest, taxed very differently. Now, I want to point something out that's very important. When you were working, Our channel's for retirees. I'll assume you're near retirement or retired. When you were working, it was very difficult to control or pay less taxes. Why? Because most of your income was coming from a job. It's W-2 income, it's ordinary income. It's taxed at the highest rates. Nothing you can do about it. As a retiree, you have much more control of where and how you get your income. So let me give you an example. If you buy a stock and get dividends, those dividends are taxed most likely at 15%. Some people pay as high as 23.8. A lot of people pay 0. So let's just use 15% as the figure. However, if instead of buying stock and getting dividends, you decide to buy a bond and get interest, that interest is taxed at ordinary income rates well over 30%, could be well over 30%. Now you might say to yourself, well, why does the IRS tax me less on a dividend than they do on interest? As I said, there's no logic to the tax rules. It's your job or your tax planner's job to exploit them. So we've got several different kinds of tax. Number one, we've got Social Security. That's taxed in a certain way that's taxed differently from all other types of income. You've got dividends. Dividends have their own special tax rules. Then you've got capital gains that are taxed very similar to dividends. Most people, again, pay 15%, but sometimes you'll pay 0%, and we're going to look at that in a future video. You've got withdrawals from your IRA. Those are heavily taxed. That's why you want to always use your IRA money last. Or if you have charitable intentions, you always want to leave in your estate plan money from your IRA to a charity, because then you won't pay the tax and neither will they. You've got interest income like CDs, treasury securities, bonds. Interest income, heavily taxed, not the best type of income to have, taxed at your highest rates. And then annuities. Annuities are interesting because they do have some tax shelter aspect to them. So we're going to look at that in one of the future videos. So now we've got these 6 types of different income. We're going to explore each of them and see how you can use these different ways of being taxed to your advantage. Now remember, I'm going to do a separate video on each one of these different categories of tax. So they'll be short, but make sure you click the subscribe button below and the little bell icon so you make sure and get notified. Now the very next video, in fact, you'll probably be able to see it in 2 minutes. When I'm all done, there'll be a little plaque at the end of this video to click on the next one, which is how to reduce or eliminate tax on your Social Security income. See you soon in a few minutes.